Okay guys, today I'm going to talk to you about business ownership and the different types of organisations that you can find and the kind of organisations that entrepreneurs when they're setting up a business have available to them, and what are the different types of ownership and the benefits and drawbacks to each one. So the ones that we're going to look at, guys, we're going to look at today is sole trader, partnership, private limited company, public limited company, and also franchises. So this is going to be quite a long podcast. It's going to take me a while to get through these things, but this is probably one of the most important topics that you cover in IGCSE. You get questions time and time again on this, guys. So it's really important that you're fully up to date on business ownership. Now the first two that we're going to look at are the unincorporated businesses, and they are sole traders and partnerships. Then we'll move on to the incorporated businesses, which are private limited companies and public limited companies. So starting off first of all, guys, just a quick recap over what unincorporated and incorporated means. Now, unincorporated, so this is a sole trader and a partnership, and that means that the business and the owners have the same legal identity. So they're viewed as the same people, as the same thing, okay? Whereas incorporated business, the business and the owners have a separate legal identity. So you have the business and the owners, and they are viewed as separate things, separate identities, okay? Now, I'll go over this in more detail later. This really has a main importance and a main bearing when we're talking about liability, okay? So unincorporated businesses, sole traders and partnerships have unlimited liability, whereas incorporated businesses, remember incorporated, we have a separate legal identity from the business and the owners, and that is what we call limited liability, okay? So let me go over the types of business ownership. So the first one, we have a sole trader. Now a sole trader business is a business owned and controlled by one person. That's what the word sole means. Sole just means one, okay? So they tend to be small businesses such as plumbers, window cleaners. Their business is owned and controlled by one person. It's just one entrepreneur going around running his own business. The benefits of being a sole trader, so because it's a business owned and controlled by one person, the entrepreneur, the owner, gets to keep all of the profit. Don't have to split it with anybody because they're the person who owns the business. They get to make all the decisions, again, because they're the one running and owning the business. There's no partners, so there's no disagreements. You don't have arguments because you have nobody there to argue with. It's your business, you do what you like, you make all the decisions. Last advantage on there, guys, the lack of legal regulations. It's very easy, very quick to set up a sole trader business. There's no laws, there's nothing you have to fill out, there's no paperwork or anything like that. You just start selling, you just start trading. Very quick, very easy to set up. Whereas the other types of businesses that we will look at, the private limited companies and the public limited companies, are much more difficult to set up because you have legal documents to fill out and complete. Whereas as a sole trader, to start selling, very quick, very easy to set up and run. The drawbacks of being a sole trader, well, because it's only you on your own, you're in business, just one person, okay? So if you take time off, your business is going to be shut. There's nobody there to run your business, nobody there to operate it if you're ill or if you're on holiday. Long hours, because it's only you in business on your own. You cannot share decision making with anybody. You have no partners, nobody to talk to, nobody to get ideas from. So there's less ideas in a sole trader business, nobody to share decisions with. It's hard to expand, again, because it's only you. So in order to expand, it's very difficult, and we've got nobody there. The sole trader is the person doing all of the work, making all of the decisions. Okay, so there's fewer ideas, there's more work for that person to do. And lastly, unlimited liability, which is a disadvantage that goes into that box just there. I will talk to you again once I've finished partnerships about what unlimited liability is. So if you're still a little bit unsure what unlimited liability is, please bear with me, and I will come on to that. Just remember, guys, sole trader businesses are businesses owned and controlled by one person, but they can employ staff, they can employ workers. But remember, it's the sole trader who owns the business, who runs it, controls it, makes all the decisions. And if there's a loss and the business fails, it's the sole trader, the owner, that has to pay it. So they can employ workers, their staff, but remember, the workers aren't the ones who are running the business, it's the sole trader. And partnerships, so pretty similar to sole trader, but a sole trader business has one owner. Partnership has 2 to 20, so a minimum of 2. Obviously, if you had one, then that would be a sole trader. So it's a minimum of 2 partners, up to a maximum of 20, and that would be a partnership. Benefits of being a partnership, well, because you're working with people, you have people working with you, partners. and you can share the workload and you can share the decision making. And because you can share the decision making, there's more ideas there. So, but if you've heard the saying, 2 brains are better than 1. So if you have 2, 3, up to 20 brains, there's more ideas there in a partnership, and there's people there to help you with the workload. Okay, so you can take time off, your partners can cover for you. More finance can be invested in a partnership because each of the partners, when they come together, let's say you have 5 partners, each of those partners will bring money, they'll bring investment with them, and that money will be invested into the business. So partnerships have more finance available than a sole trader business would. Again, you can take time off because you've got partners there that can fill in and cover the business while you're on holiday or while you're sick. And it is easier to expand the business than it is as a sole trader because you have partners there to help expand the business. The drawbacks of a partnership, because it's not just you, it's not only your business, you now have partners that you're sharing the business with. You do have to split the profit. Big disadvantage because now you've got to share the profit with somebody else. Partners might have disagreements because there are more partners, and again, you might have different opinions, you might have different ideas. Your idea might not get chosen, or somebody might not like your idea, or you've got to persuade them into your idea, so you can have disagreements and arguments. And slower decision making because you've got to talk, you've got to discuss the decisions, you've got to discuss the ideas, so that can slow the decision making down. Unlimited liability goes into this box. Unlimited liability is in red because that is a disadvantage, and sole traders and partnerships, because they are unincorporated businesses, have unlimited liability. A deed of partnership, so partnerships can create a deed of partnership, and a deed of partnership is a legally binding agreement. It's a contract basically between all of the partners, and it talks about how the profits and how the losses and how the responsibility and the roles and the rights of the partners, how is that partnership going to be run? Almost like the rule book of the partnership. So the idea of a deed of partnership, it stops arguments. Because if you have one partner who invests $1 million and another partner who invests $500,000, how should the profit be split? Well, you might argue that the partner who's invested the most money should take the most amount of profit. Well, if there's no deed of partnership, by law, the profit is split 50-50, equally between the partners. Whereas a deed of partnership is a contract, and you may say, because you've invested more money than me, you should take more profit. Now, if you have a deed of partnership and you create this at the beginning, there'll be no arguments, okay? Whereas if there's no deed of partnership, then there's going to be arguments within that partnership business. Okay, so a deed of partnership, like I've got on here, guys, just sets out how much capital each partner will contribute, how the profits and also losses will be split and shared between the partners, how much control does each partner have, so who has the most amount of votes, who has the least. And again, this will all be based on how much money you've invested. The person who invests the most would take the most profit and should have the most power in the business. And this is set out in a deed of partnership. So this is stopping arguments within the business. Okay, unlimited liability, guys. So if you think back from lesson when we did this, liability is just when you owe somebody money and it's you owe somebody something. Now, this business, guys, we have debts of £1.1 million, and if you have unlimited liability, then that means you cannot pay somebody back. So let's say you owe the bank money, your business is doing very, very badly, you cannot pay them back, you're struggling to pay them back. Eventually the bank is going to say, no, enough's enough, your business is failing, and they're going to start taking belongings, what we call assets, off of you. Now, with unlimited liability, if you owe £1.1 million, first of all, they can take your factory. This is your business possession, your factory. They can take that off of you. Now, that hasn't paid back the money that you owe, so they can then take your truck, your lorry. So they've taken your business possessions now. So they've taken £600,000 of your business possessions to pay back the £1.1 million. But because you have unlimited liability, they can also take your personal house and your personal car. So with unlimited liability, they can take your business possession and your personal possessions. So what does unlimited liability mean? It means there is no limit to what the bank can take in order to pay off your debts. So they can take your business possessions and they can take your personal possessions. And like I've got at the bottom, this is very risky, which is why I had it as a disadvantage for a sole trader and a partnership, because you can lose everything. The bank can take everything from you, because remember, it is unincorporated, and unincorporated means the business and the owners have the same legal identity. They're the same thing. So with an unincorporated business, they can take the business possessions and the owner's possessions because they're viewed as the same thing. They have the same legal identity with it being unincorporated, and that is what we call unlimited liability. They can take everything, business possessions and personal possessions. Okay, we're going to move on now and look at the private limited companies and the public limited companies. Okay, so like I said before, guys, private limited companies and public limited companies are incorporated businesses. So that means that the owners of the business and the business itself have a separate legal identity. So the owners and the business have a separate legal identity. So limited companies, first of all, both limited company types, private and public limited companies, like it says at the top, are owned by shareholders. So shareholders is the name given to people that own private and public limited companies. Now, what are shareholders? Shareholders are investors into the business. They invest their money into the business. You can do this right now. You can go on the internet, buy some shares in a public limited company like Apple, and you become a shareholder. That means you legally own part of Apple. You are an owner of Apple. Okay, so shareholders are people that invest their money into limited companies. Okay, just a quick recap, guys. So shareholders are the owners of the business, and the AGM, the annual general meeting, the shareholders can vote for new directors of the business. So directors and CEOs, remember, the senior top level managers that run the whole business. They do the strategic long-term decisions, and the shareholders can vote for new directors and new CEOs. Just remember, it's the shareholders who own the business, but it's the directors and CEO who run the business. So we have two different types of people here. We have shareholders who own it, directors and CEOs who run it. Okay? And the shareholders, because they own the business, they can vote for new directors and new CEOs at the AGM, the annual general meeting. Now, when you invest money into a business, you don't just give your money to that business and say, there you go, Apple, enjoy my money. You invest that money in the business, and because you invest that money in the business and you become a shareholder, that means you can take a share of the profit. So when Apple or any public limited company makes a profit, they will share a percentage of that profit back. They will give it back to their shareholders as a reward for investing in the business, and this is what we call a dividend. So that dividend is the reward for being a shareholder. It's basically to keep the shareholders happy, yeah, so that they get a return on the money that they've invested into that business. Okay, so like I just said, guys, we have the directors who are appointed by the shareholders. It's the directors who run it. It's the shareholders that own it. Okay, and these are the people that run the business, the directors, and they can be voted in or out at the AGM. So it's really important that the directors keep the shareholders happy, because if the shareholders are not happy, if the people that own the business are not happy, they can vote the directors out, and the directors basically lose their job. So this is one of the drawbacks of limited companies, that limited companies need to keep the shareholders happy, and they also need to keep the customers happy. But who in business do we really want to keep happy? Well, it's really the customers, isn't it? This is the problem that limited companies have, that they have to keep shareholders happy, and they have to keep the customers happy, and that's a bit complicated. Okay, think back to when I just said about sole traders and partnerships. Sole traders and partnerships, very quick, very easy to set up, no legal documents to fill out, nothing, you just start trading and you start selling. Well, that's not the case with limited companies. Limited companies, this is private and public limited companies, need to complete an article of association. Now, articles, almost, if you can see there, spells rules, R-L-E-S, okay, almost spells rules. Article of association are the rules of the company. Don't worry if you forget what an article of association is. I think it's very highly unlikely that you will get asked what is an article of association. Just remember, article of association and memorandum of association are what you need to fill out, or what you need to complete in order to set up a limited company, whether that be a private or a public limited company. The memorandum of association, this contains the information about the company, such as the company name, address, company objectives, and the share capital. These are legal documents, guys. They take a long time to fill out. So these are drawbacks to becoming a limited company. It's time consuming and expensive to set them up, because you have to fill out an article of association and a memorandum of association. Okay, here's just some examples. So they are long written documents that you have to fill out in order to create a limited company. Okay, I'm now going to go over the two types of companies. Now, public limited companies, these are, like it says on here, the largest types of companies. They have PLC at the end of the name. So PLC stands for Public Limited Company. And remember, they are owned by shareholders. So they have PLC at the end of the name. To be an owner, you have to buy shares, so you have to invest your money into the business. You become a shareholder. And because it's a public limited company, that public means anybody can buy shares. Shares are sold to the public. Where are they sold? They're sold on the stock exchange. So you go to the stock exchange and you can buy shares in any public limited company. Okay? Now the benefit of being a public limited company, because you can sell shares to the public, that being the whole world pretty much, because you can sell shares to people, people will buy a share of your company, a percentage of your company, that allows you to raise large sums of finance. So they can raise huge amounts of money. Please do not say they can raise profit. They are not raising profit, they are raising finance. They are raising money from investors. Okay? They can take more risks because they have limited liability. I will go over, in case you need a recap, guys, what limited liability is, but limited liability is an advantage to limited companies. And it's easy to expand and open more stores because they can raise finance much quicker and much easier. They just sell shares on the stock exchange, and that allows them to raise finance. And if you want to be big, if you want to be a big company, what do you need? You need finance. You can't be big without finance. So that's why all the biggest companies in the world, Apple, Microsoft, Samsung, Toyota, they're all public limited companies, because if you want to become big, if you want to be a big business, you need money, and public limited companies can raise big sums of finance by selling shares on the stock exchange. If you're ever confused about what type of liability a public limited company or a private limited company has, the clues in the title, they are called limited companies, and the reason why they're called limited companies is because they have limited liability. So please just remember that. The drawbacks to public limited companies: shareholders become owners, and because shareholders become owners, you are selling them a percentage of your business, so there is a loss of ownership, and that is the word that I want you to use when you're talking about limited companies, public or private limited companies. Whenever you sell shares, there is a loss of ownership because you are giving somebody or selling somebody a part of your business. Public limited companies, because you have no control over who buys shares, anybody can buy shares. They can just go on the internet and start buying shares. Even your competitors can start buying shares in your company. If they keep buying all of the shares one by one,